Well, I think they have been basing their outlook and their policy on two lagging indicators. Seems they've been paying more attention to the CPI year over year, which is still at over 8%, and employment. Both of those are lagging indicators. The leading indicators, which are all in the pipeline, easy to see right now, are all saying that prices are going to come down.
With two of Europe's largest economies caving into inflation pressures in the past week, more and more market experts are warning investors to expect a prolonged recession within the next 6 to 12 months. During the week, ARK Invest CEO Cathie Wood, Citadel CEO Ken Griffin, and renowned billionaire hedge fund manager Stan Druckenmiller warned investors about the current trajectory of the U.S. economy amid the ongoing global economic meltdown. Speaking on CNBC's Squawk Box earlier in the week, Wood discusses her expectations for interest rates and inflation in the months ahead. According to the popular investor and portfolio manager, the U.S. Federal Reserve is overlooking key economic indicators, signaling months of deflation. She adds that demand is being destroyed at an alarming rate, and if the Federal Reserve continues with its aggressive rate hikes, then investors have to be ready for a more severe economic downturn. In the same vein, Citadel's Ken Griffin says inflation may have peaked, but a recession is almost a certainty for the U.S. economy. We are in a very uncertain time for investors, Griffin warned on Wednesday, adding that the Federal Reserve is grappling with a level of inflation we haven't seen in a long time. Like Wood, Griffin does not believe we could get a soft landing before the economic situation begins to ease up in 2023 or 2024. We will now take you to Wood's clip. Please watch, share, and like this video. Also, ensure you drop your comments and observations in the comments section and subscribe to the channel for more videos like this. Thanks and enjoy the video.
It's very interesting to hear people saying that we'll be able to skirt recession. We believe we are in a recession. The durable goods orders we just saw, really we're seeing the strength there because of activity being attracted to the U.S., a flight to safety. That's why our dollar's been going up as well. Nonetheless, we think we are in a recession. We're seeing tremendous demand destruction. You see demand for gasoline over the summer down to 25-year lows, 1997. Think about that. So lots of demand destruction, and we believe it will continue. The good news here is to hear Michael Evans this morning talking about, hey, we're all on the same page. This could be done in the first 3 months of next year. Well, if the market is the discounting mechanism that it should be, then it should be discounting the peak in interest rates. Yes, inflation peaked. We believe core inflation peaked at 5.3%. This is the PCE deflator that the Fed supposedly pays the most attention to, 5.3 in February. It's down to 4.6. And with all of the price declines that we are seeing out there, whether it's in retail because of too much inventory or way up the pipeline with commodities really falling out of bed, all of them, we think the inflation rate is going to be surprisingly low. We would not be surprised to see deflation month to month sequentially for a number of months during the next 6 months.
Does that mean that you are betting that the Fed eases up in a way that they have not signaled thus far?
Absolutely. I think they do not appreciate how much demand destruction has taken place out there. But this holiday season, I think, will be telltale that way. And so I do think we're looking at a major pivot. If we're right that deflation, and we've been saying this for a while, so consider the source, but if we're right that deflation, both for cyclical reasons and for secular reasons, all we do is look at technology and the cost declines associated with different technologies, and they're massive. So we think that inflation during the years ahead is going to surprise significantly on the low side of expectations. Well, I think they have been basing their outlook and their policy on two lagging indicators. Seems they've been paying more attention to the CPI year over year, which is still at over 8%, and employment. Both of those are lagging indicators. The leading indicators, which are all in the pipeline, easy to see right now, are all saying that prices are going to come down. Inflation certainly will come down, but I think the big surprise out there is the number of months we will see actual deflation, negative prices. And it's not just because of the U.S. In fact, we're benefiting from the flight to safety from the rest of the world. What's going on in China is highly deflationary. What's going on in Europe, the same. This energy is a huge tax on that continent. One of the other things that's happened in the last in the last week that I think is fascinating is that both Japan and China have basically supported their currency, and they're basically saying no mas. And in order to do that, what are they doing? They're selling dollars and buying their own currency. So effectively, China and Japan are doing some of the easing that we think the Fed will do, increasing dollars in the system.
Wood believes that countries like China, Japan, the United Kingdom, and Germany putting a hold on quantitative tightening will trigger a similar move from the Federal Reserve, despite Chairman Jerome Powell's insistence that that will only happen when inflation drops significantly. What do you think about Wood's assessment of the U.S. economy? Please drop your replies in the comments section. As stated earlier, Cathie Wood is not the only one calling attention to the risk of further economic decline. The founder and CEO of global investment firm Citadel, Ken Griffin, has discussed similar sentiments. While speaking at the CNBC Delivering Alpha conference on Wednesday, Griffin said, "It is a very uncertain time. We are grappling with the threat of nuclear war in Ukraine, unprecedented central bank interventions, and record-high inflation in the United States. We are in very uncertain times for investors." He also gave his expert opinion on whether the U.S. economy will go into a recession. He stated that there would be a recession, adding that it is just a question of when and how hard. In addition to Wood and Griffin, billionaire hedge fund manager Stanley Druckenmiller has warned U.S. investors about the possibility of a recession in 2023. The billionaire investor believes that the Federal Reserve is responsible for the current state of the economy and that its aggressive rate hikes will not end well for the U.S. economy. Here's a short clip from the interview.
I will be stunned if we don't have a recession in 23. Don't know the timing, but certainly by the end of 23. I will not be surprised if it's not larger than the so-called average garden variety. And I don't rule out, not my forecast, but I don't rule out something really bad. Why? Because if you look at the liquidity situation that has driven this, we're going to go from all this QE to QT. We're following an asset bubble. We've been doing all this running down on the SPR, which is now...
At the Delivering Alpha conference on Wednesday, Druckenmiller also discussed the role of cryptocurrencies in the next era of the global economy. Reacting to the news of the Bank of England buying £65 billion of UK bonds, the billionaire investor predicted that cryptocurrencies would take on a big role if things get really bad and other central banks make similar moves. Though he also revealed that he doesn't own any cryptocurrencies. "It's tough for me to own anything like that with central banks tightening," he disclosed. Do you think the United States is already in a recession or heading for one within the coming months? Please let us know what you think and how you are preparing in the comments section below. Also, be sure you hit the like button, subscribe to the channel, and turn on post notifications so you get notified every time we upload a video. Thanks for watching.